today. Always appreciate coming out and
Of course.
seeing you guys.
Thank you.
Grab this. And just a quick background on myself, as Austin mentioned, I've been there for almost 9 years. Sorry?
Take your mic.
Oh, I'm not the tech guy, so I think that's a little bit better. All right. Pleasure to be here. Great to see everyone out on this Saturday morning. And just to touch on what Austin said, I've been at Centurion for almost 9 years now. And it's been exciting to see the growth in the company, but I always like to say it's a very boring investment. Just keeps chugging along and keeps investors very happy. If you want excitement, we got some cryptos or some stock market tips for you. But this is a very boring investment that I think investors are really, really appreciative of. And this is just the firm itself. I'll give you a quick background. It was launched by Greg Roman. I'll show you his bio in a second. But the REIT itself was launched in 2009. And at the time, it had about $55 million in assets. And then you can see the growth since then. And right now, we're at 148 buildings in the portfolio, up to $6.2 billion in AUM. And when we started, it was Greg Roman and two people with him. Now we're at 320 employees and continue to grow. We're continuing to buy buildings. We're continuing, obviously, to bring on new staff as well. So it's been exciting to see that growth. But I will say it's growth done the right way. There's a real discipline at Centurion that we're going to make sure we make acquisitions that are good for the portfolio, are good for investors. We're not going to buy or grow just for the sake of growing. And I'll give you more details on that approach. Greg's career before he still started focusing on real estate was as a derivatives trader. He had an extremely successful career. He worked in Toronto, New York, London, Hong Kong, and Singapore. Did extremely well for himself. He built out derivatives trading desks, and his last role was actually in Singapore, senior VP, senior partner rather, for AIG, running pretty much the emerging markets derivatives trading desk. But as a derivatives trader, your job really is to help your clients mitigate risk, always find ways for them to minimize the risk that they're facing in their business. And so he really brings that mindset to Centurion. His approach has always been protect investors' capital first and foremost, give you some income, then give you some growth on top of that. And every decision, I would say, is done really with an eye to the long term. We're not going to take some short-term shortcuts, anything like that. And he is the largest investor in the company as well. His money is fully invested. I think besides Centurion, he owns some physical gold and physical silver. So he is there with you every step of the way. And he's only 53. He'll be around for quite a while. But I do get this question, so I'll just answer it now. What happens if he gets hit by the proverbial bus tomorrow? The gentleman below him, Steve Stewart, will step in. Exceptionally sharp individual, runs our real estate lending. He would take over. But the firm itself is built to last well past Greg. It continued to grow, continue to build it out, and it's something you would see probably lasting another at least 100 plus years. And this is the performance since inception of the fund. And you can see here, one, I'll just point out two things. 2009, that was a 4-month period. But a couple errors, I'll say that 2017 to 2019, our target return is 7 to 12%. So that's income plus appreciation, plus growth. Those were very strong years. It was a situation where housing was increasingly unaffordable, where there was a lack of supply and demand was increasing. Very similar situation to what we're seeing right now. Can't say we'll get those type of returns. We always say our target return is 7 to 12, but things are looking exceptionally strong for the environment that we're in right now. 2020, I think, though, is probably really a highlight of how well we operate as a firm. We take the operations side of the buildings extremely seriously. We do that in-house, and that's very purposeful. We want to make sure we run those buildings properly. We want to make sure we make investments. We want to make sure it's a great investment for you. Obviously, as an investor, it's going to return a decent amount for you. But at the same time, we want to make sure it's a good building for tenants. We want to make sure that it's a safe building, it's a clean building, it's well run, it's efficient. So we make investments in the buildings. We run them ourselves. But I say how we operated in 2020, obviously a year of extreme uncertainty. It's not hopefully it doesn't happen again, but we did extremely well in that year. And I'll just touch on that. Our rent collections on the first of the month, we usually come in about 98%, 98.5%. Zero change during that COVID year. And when I talk about the operations, we also take it seriously who our tenants are. So we want to make sure that we screen our tenants for, one, income. The rent's no more than 30% of their income. We want to make sure they can actually afford the rent. We also do a credit check. We also do a background check on them as well. We do a tenant check, make sure they haven't been running around ripping off people. And I just ask, we get that question, like, what do you do with delinquent tenants? Most tenants are good. They pay their rent on time. But at the same time, there's going to be a few that can't. For whatever reason, life happens. If they come to us, we work with them. We'll put them on a repayment plan so they can stay in their unit. There's always going to be a few who don't want to pay, and we do deal with that very quickly. And we can get delinquent tenants out who refuse to pay out of our units in 2 months. It's a process we know very well. And we've heard, I think, every sob story they can possibly come up with. So we do take that operations very seriously. That is, I think, a real hallmark of Centurion itself. And you can start and look at 2022 and 2021. You can see the returns are coming back again for investors. I'd like to say it's a very exciting time to be in a very boring product like Centurion. This will go over as well. This is the Q3 data on our mortgages, on the cost of financing for Centurion. The Q4 numbers we just came out, slight increase. Our leverage right now is 45%, so we've used debt very, very prudently. At the same time, our weighted average mortgage rate is 2.9%, slightly up from Q3. All of our mortgages, though, are fixed rate. We've never done variable. That's always been very purposeful. You want to fix in your costs, understand what your financing costs are. And again, it comes back to the mentality, the focus of management, protect investors. Why take that variable rate risk? And you can see that's especially paying off right now. And our average term is just over 6 years. So if we look at it when we're doing a mortgage, we kind of look at the yield curve between 5 and 10 years and see where we can get the best financing for us. And we always extend maturities. And this year we're going to have 90 million rollover. Next year is about 65 million rollover. You always want to see some mortgages roll over. You don't want to have some year where it's just a massive balloon payment. But we have been extending maturities as much as we can. I'll just quickly touch on this. Another data point right there is we have about 5% of our fund is lending. We lend to the developers so they can build buildings, apartment buildings that we can ultimately acquire. Our lending rate here shows 11.79. Actually, now it's 12.26%. This gives us a little extra, I guess, protection in this inflationary environment. So it gives us a little bit of extra income coming into the portfolio. The last line there is the liquidity that's available. We have about 50 million in cash. I think just right now, due to the uncertainty, it's prudent to have some cash on the books. The rest of that is our line of credit. So we have about a $200 million line of credit. You push that higher, we're probably going to increase our credit to, I think, 350, maybe 400 million. The reason behind that is there's the potential for distressed sales coming to the market. Operating apartment buildings, it was easy at one point. Pre-COVID, it was, in Toronto area, it was like shooting fish in a barrel. You had an apartment building, people would show up. Then operating got a lot harder, and we're seeing now, especially with rising interest rates, over-leveraged bad operators maybe selling their buildings into the marketplace, maybe selling them at distressed prices. So we want to have the liquidity, be able to go out there and close on those opportunities. They may not happen, but it's a line of credit. We're not going to use it unless those opportunities are there for us. And these next few slides will just give you a bit of, perspective on what the market looks like. This is from CMHC. There's a few slides on here from CMHC, the Canadian Mortgage Housing Corporation. And you can see here, the vacancy rate across the country is at 1.9%. Somewhere, I think Vancouver right now is at 0.9%. So it's extremely low. It's an extremely tight housing market across the country. That average 2-bedroom rent, that's definitely not Vancouver or Toronto prices. But I will say this, and I think the prior presentation touched on this, is lack of supply, increasing demand. And I'll show you a few slides on that as well. But you can see here, in the year ending October last year, 55,000 purpose-built rentals were put up. Sounds like a pretty good number, but there's an uptake of 79,000. The demand far outstrips the supply that we're seeing here in Canada. And I'll stress that. The demand is continuously outstripping the supply that we have available. And this just shows you a little visual on the vacancy rate here in Canada. It's about 20-year lows. And I don't see it turning around. I always stress this. In Canada, where we can be slow to build, and we have a great example. We have 2 properties in Texas. Our focus is on Canada, but we do have 2 properties down in Texas. We actually lent on one of those projects. The developer, bought the land. You officially take possession 2 months later. When he officially took possession, permits were in hand. Get building, get to work. Talk to our lenders here. 2 years, if you're lucky, probably closer to 3. And then God forbid if someone doesn't like what the building does to the aesthetic appeal of the neighborhood, NIMBYism kicks in, and it could be a lot longer than that. So we are slow on building. Every year demand is increasing and we're slow on building. And these are really the top three what I'll focus on here. There's some very powerful fundamental tailwinds in the housing sector on the rental space. Unaffordability. The one place I go in the country where it's more expensive than Toronto, it may pull back on the housing prices may pull back, but the cost of mortgages obviously went up considerably. So it's not more affordable. Same time, we're obviously seeing strong immigration. Year after year, we're having increasing numbers of immigrants coming to Canada. The target over the next 3 years is going to see about 1.5 million. And again, the prior presentation made a very interesting point. The true numbers are a lot higher. And there's actually a very interesting report from CIBC regarding that. The true numbers are a lot closer to 1 million than what you're seeing. And then the rental supply again. We're not going to keep pace. We're very slow on building. It's not going to happen. I love Canada, but we're slow on doing things. And here's the increase in population that we're going to be seeing over the next few years. But again, I don't think this is a true number. The true numbers are going to be a lot higher. But again, the great thing about this is just demand continuously growing, coming into an undersupplied marketplace here in Canada. We're buying as many buildings as we can, but the demand continues to outstrip what's available in the marketplace. And they did touch on here again, there's a lot of international students here in Canada. We like it. We have some student housing in our portfolio. Universities love it. They charge them 3 to 5 times as much as Canadian students. But there's a lot of people coming to Canada, getting great education, and they want to stick around. About 60% of those international students want to stick around in Canada. So again, just more added demand for housing. I'll really just touch on a couple of these bullet points here. One is the first one on top. There's a little report done by the federal government and CMHC where numbers were starting in 2021. But from 2021 to 2030, we were on track to build about 2.2 million homes. But the federal government and CMHC said to make housing more affordable, on top of that 2.2 million, we had to build an additional 3.5 million. If I were to guarantee anything, that's not going to happen. Issue with that is, like I mentioned, things are slow to be built in Canada, but also there's a lot of skilled labor that goes into development projects. You don't automatically grow, plumbers and everyone who works in the construction site. You don't automatically appear. And there's interesting stats on that. We're seeing for every 5 individuals who kind of quit, if you will, the construction industry, only 2 are replacing them. So we wouldn't have the skilled labor to build these projects anyways. Even if all the red tape went away tomorrow, we wouldn't have the labor, the skilled labor, to build all of these projects that we desperately need here in Canada. So we're continuously going to be undersupplied in this country. And I'll touch on this bottom point here as well. You can see in Metro Vancouver, 44,000 population growth over the next 3 years. We're on track to build 1,500 purpose-built apartment units. Not apartment buildings, apartment units. So 4,500 apartment units over the next 3 years. I think that's going to be a little bit low. And I'll talk about the supply as well. In Toronto, and you're doing, I think, something similar here in Vancouver, where you can build laneway houses. You can get a house and build a 2-plex or a 4-plex to add some incremental housing to the market. That is a drop in the bucket. That's not going to do anything. It sounds great, politicians are doing something, but it's not anywhere near enough to actually get the supply that we need in this country. And I'll answer another question I do get, well, there's not enough supply, where does everyone live? And you see situations where people are doubling up in houses, doubling up in more suburban houses and cheaper housing, where they're living in basement apartments, or they're obviously renting from someone like Centurion. People are obviously finding somewhere to live, but it's maybe not the most desirable location for them. This is a breakdown of where the portfolio is geographically, and I'll break it down this way. In Canada, we focus on, in Ontario and BC, we're only in the primary and secondary cities. In primary and secondary cities in Ontario and BC. So meaning we're not downtown Vancouver, that's not our price point. We're not downtown Toronto, that's again not our price point either. We want to be middle income type of housing, which has far more affordable options for people. But we're in the suburbs, we're in Surrey. I know Kelowna is not where it shows on the map, but we're on Vancouver Island. We have a couple buildings in Victoria. We have 7 in Langford. We're getting another one. We love Langford. We have a little street there with all Centurion buildings. Ontario, similar situation. We're in the suburbs. If you know Toronto, we're out in Scarborough, in Etobicoke, the Mississauga, and then further afield east as well. And we go down into southwestern Ontario, kind of up to Ottawa. And we have a few buildings just north of the city as well. But the rest of the country, it is just the primary cities. And this is very purposeful, obviously. We want to be where people want to live. So if you look at Alberta, there's really 2 major cities, obviously Calgary and Edmonton. You go to Saskatchewan, we're in the provincial capital, Regina. Obviously Winnipeg, about 700,000, 800,000 people in there. Even in Quebec, the largest rental market in Canada, we're only in Quebec City and only in Montreal. Again, we want to be where people live. We want to be in the more suburban areas, removed from the expensive downtown cores, so it's far more affordable for a lot of people. When I say downtown core, I live downtown. I bought my condo 12 years ago, very happy with that. But the rental prices downtown, in my building itself, the 1 bedroom, the cheapest I've seen it was $24.50. A brand new rental building actually went up just down the road from me. I can walk there in 30 seconds. The cheapest unit in that building is a bachelor, was less than 400 square feet. I think it was 365 square feet. That was going for $24.50. The biggest 1 bedroom in that building was going for $3,700. And then you can obviously see the 2 bedrooms would go a lot higher than that. Like certain areas are very expensive. We're not in those. And that's very purposeful. Our portfolio is far more resilient to the economic cycle. And actually what we're seeing right now are better qualified tenants coming into our buildings. Simply meaning they have higher income, they have better credit scores than we've necessarily seen in the past. Again, we have good tenants in place, but we're seeing people who traditionally would be able to buy somewhere. Now they have to go into the rental market for a few years before they can actually jump into home ownership. So we're seeing that. But again, the highlight is our portfolio is extremely resilient. And I'll tell you right now, our occupancy rate, our stabilized occupancy rate is 98%. Overall portfolio occupancy rate is 95. The difference between those two is stabilized is kind of X out the acquisitions we made over the last kind of year. So simply meaning this is the kind of the long-term occupancy rate that we're able to generate for the portfolio. Sorry, I'll touch on a few other things on this slide. One is the lime green are the student housing buildings we have. We have 15 student housing buildings in the portfolio, doing exceptionally well for us. They're about 99% occupied right now. They took a bit of a dip during COVID down to like 82%, but they're back to the kind of long-term average of pretty much 99%, doing extremely well for us. We do have the dark blue, and that is medical offices. That was an acquisition we made, I think it was about eight months ago. And we got a portfolio of buildings. Really, I would say there was a very motivated seller on one side of it. They weren't running the building very well, and again, high interest rates kind of reveal, I guess some sins of bad management. So they were a very motivated seller. We were able to get in that, buy that portfolio. The focus on this, I think, is maybe hold it for 3 to 5 years. Then if the right buyer comes along, we'll look to sell it. But really buy and hold. Our focus is always going to be buy and hold. And also I said this a bit earlier, is operations, we run the buildings ourselves. But I'll say this, apartment buildings and student housing, we know how to run them. That's our business. But with the medical offices, we work with a third party. We own 75% of that portfolio. We have a third party that runs the buildings. They own 25%. So I guess necessarily they're not a third party. They have considerable skin in the game, but that's their business. They operate those medical offices. And right now, we've got that portfolio at 75% occupancy rate. Now it's up to 89% occupancy. So they're doing a very good job for us. We have 4 properties in the US right now. Focus is on Canada. There's a big difference between those 2 countries. One in Canada, if you sell a building, you're taxed right away. In the US, huge market, very liquid market. You carry forward your gains. You're not taxed right away. Very different. So Canada is far more buy and hold. And we're seeing a lot of opportunities. The pipeline for us right now, acquisition-wise, over the next 12 months is $1.5 billion. We won't get all $1.5 billion of those projects. Maybe we get 400 million, 500 million worth, but there's a lot of opportunities for us. We're in a very strong position going into this environment. Again, we have very good liquidity. We get very cheap financing, and we're right through teams like obviously Taylor, Centurion, and Austin. We're raising equity from investors. So it's opportunity set before us is very exciting. And this is just a great example of one of the more recent acquisitions up here in Kelowna. And these are the type of buildings we're going to be buying. Predominantly, it's going to be all new builds. And again, the focus on this is middle income type of buildings. Young professionals, people who can't afford to buy, retirees who want headache-free living rather. And the amenities in this is kind of like a condo. You got your fitness rooms, outdoor areas, business center. And we see this a lot more pet stations or pet wash stations. One of our buildings actually has a pet run on the roof. I don't know why you wouldn't just take the dog outside, but. So these are the type of buildings that we're getting into our portfolio. And with this building, actually the bachelors in this start at $1,650, and then the 2 bedrooms, 2 bath go up to, the most expensive is $2,550. So again, very affordable for a lot of people. And I do stress that. We want to make sure we're in that middle income market, very wide potential tenant base that can come into our portfolio. And I think that's really reflected by the rents we're able to generate, but at the same time, the returns we're able to generate for investors as well. On this, I'll touch on just a couple of things here. One, it is a monthly income that we do pay out, but being a REIT, there's a real tax efficient benefit to that. Roughly on average, or longer term average, about 60% of our income is return of capital. What a return of capital is a tax treatment. Does not mean we're giving you your money back. I stress that. The distributions we pay are generated from the REIT. We generate the money and that's what we use to pay you. Return of capital is a tax treatment. But it simply means you don't pay tax if it's an unregistered money. You don't pay tax on that portion of your distribution. It does lower your average cost base, but you defer your taxation on that. Government will always tax you, but this is a great way to defer it. One of the few ways you can defer it effectively. And I'll highlight as well the oversight. We are a private REIT. We value our entire portfolio every quarter. So every quarter we work with a third-party appraiser. They look at every one of our buildings, look at market comparable sales around those buildings, get the price that these buildings are transacting at, get the cap rate that those buildings are selling at. And then they sit down with our finance team who brings in the income data. They put those numbers together, see if there should be an increase in the value of the portfolio or not. They take that to the executive team, likes to review what's going on. Then it goes to a full board of trustees, majority independent board of trustees, and I'll say a very skilled, highly experienced board of trustees. And again, very purposeful. We want to make sure that we have true oversight in what we're doing. So on top of that quarterly evaluation, we also have an audit by KPMG. They audit us. We also have KPMG bring in their real estate valuations team. And that valuations team goes over every one of those quarterly appraisals that our third-party appraiser does. I think that's about a month-long process. I think the appraisers pulling out their hair by the end of that, but we want to make sure we're doing things the right way. We have the best practices in place. We want to have the best oversight in place. And if you go to our website, every material is available for you. Our OM, 200 pages there. Our financial, about 160 pages there. Everything's available for you to read as an investor. If you have insomnia rather, the OM's a great read. So, you know what? I'll leave that there. But any questions at all?